Markets are under pressure and investors are asking the same question right now. What's actually driving it? Over the past few weeks, stocks have pulled back, oil prices have moved higher, and economic signals have become more mixed. Today, we'll break down what's happening, what it could mean for markets, and what investors should be watching next. I'm Eric Pettway, Chief Investment Officer at Journey Advisory Group, and welcome to CIO Corner. Last week, markets declined with the S&P 500 down 1.8% and the NASDAQ fell 2%. The S&P 500 is now down about 4.8% for the year. International markets also pulled back, but they continue to outperform U.S. stocks so far in 2026. In response, we've made some adjustments within portfolios, increasing exposure to energy as well as aerospace and defense-related sectors, while continuing to focus on capital preservation and income generation during this period of volatility. One of the key drivers right now is higher energy prices, which have been influenced by ongoing global supply concerns and broader geopolitical developments. At the same time, markets are digesting weaker job growth, rising uncertainty, and shifting expectations around interest rates. As a result, bond markets are beginning to reflect the possibility that interest rates may remain elevated for longer than previously expected, depending on how inflation and growth evolve. And that brings us to this week's chart of the week. This week's chart helps put recent market volatility into perspective. As of March 2026, investors are navigating a mix of higher energy prices, a softening labor market, and continued uncertainty, all of which can influence portfolio decisions. As of last Friday, the S&P 500 is down about 4.8% year to date, and the VIX, a measure of market volatility, has risen to 26.8, well above its long-term average of 18.4. That tells us that investor anxiety has increased. At the sector level, energy has been a standout performer, up over 30%, while areas like technology and financials have lagged. On the economic side, the labor market has softened somewhat, with job growth slowing and unemployment rising modestly. At the same time, inflation has continued to ease, which may provide some flexibility for interest rate policy over time. Despite these headwinds, corporate earnings remain relatively strong, which is an important signal for the underlying health of businesses. The chart we're showing today highlights an important point. Market pullbacks are a normal part of investing. Inter-year declines happen regularly, even during long-term market growth periods, and historically, markets have shown a tendency to recover over time. While periods like this can feel uncertainty in the short term, maintaining a long-term perspective and a diversified approach has consistently been one of the most effective ways to navigate market cycles. We hope CIO Corner and the Chart of the Week provide helpful perspectives as markets continue to evolve. If you find this content valuable, you can follow Journey Advisory Group for future updates. And if you have questions about your portfolio or financial plan, connect with your Journey Advisory Group advisor team. Until next time, remain calm, stay focused, and most importantly, stay the course.